Welcome to this educational video on algorithmic stablecoins. Today, we're going to examine one of the most significant failures in cryptocurrency history, the Terra Luna collapse. This case study will help us understand what algorithmic stablecoins are, how they work, and most importantly, what risks they carry. By studying this collapse, we can learn valuable lessons about cryptocurrency investing and the importance of understanding the mechanisms behind the assets we hold. Let's start with the basics. Algorithmic stablecoins are cryptocurrencies designed to maintain a stable value, usually $1, through algorithmic mechanisms rather than holding actual reserves of dollars or other assets. Unlike traditional stablecoins that are backed by real money in a bank account, algorithmic stablecoins use mathematical formulas and smart contracts to adjust their supply. The key mechanism involves burning and minting tokens to keep the price stable. The entire system relies on market incentives and arbitrage opportunities, where traders profit by helping maintain the $1 peg. The Terra Luna ecosystem consisted of two tokens. First, UST, also known as Terra USD, was the algorithmic stablecoin designed to maintain a $1 peg. It had no collateral backing whatsoever. It was purely algorithmic. Second, Luna was the volatile sister token that absorbed UST price fluctuations. Luna was used for governance and staking rewards in the ecosystem. The system worked through what's called a burn-mint equilibrium. Users could always swap $1 worth of UST for $1 worth of Luna, and vice versa. This arbitrage mechanism was the foundation designed to maintain the peg. Let's understand how this arbitrage mechanism was supposed to work. If UST traded above $1, arbitrageurs would burn $1 worth of Luna, mint 1 UST, and then sell that UST for a profit. This would increase UST supply and bring the price back down. Conversely, if UST fell below $1, traders could buy cheap UST, burn 1 UST to mint $1 worth of Luna, and profit from the difference. This would decrease UST supply and raise the price back to $1. In theory, these profit opportunities would keep the peg stable. However, this mechanism had a critical flaw that would later prove catastrophic. A crucial piece of the Terra ecosystem was Anchor Protocol, which offered approximately 20% annual percentage yield on UST deposits. This was an incredibly attractive return that drew billions of dollars into the ecosystem. The high yields created massive adoption and artificial demand for UST, as people wanted to access these guaranteed returns. However, this model was fundamentally unsustainable. The returns were subsidized by Terra rather than being organically generated through real economic activity. The critical weakness was that Anchor became the primary use case for the entire Terra ecosystem. When over 70% of all UST was deposited in Anchor, the ecosystem became dangerously dependent on this single protocol. The collapse began in early May 2022. Between May 7th and 9th, over $2 billion worth of UST was withdrawn from Anchor Protocol, triggering widespread panic. This massive withdrawal caused UST to lose its peg, dropping to 91 cents on May 9th. This was a critical threshold breach that shattered confidence in the system. As news spread, mass panic selling ensued. Users rushed to exit their positions, creating enormous selling pressure on both UST and Luna tokens. What started as a moderate depegging event quickly spiraled out of control as fear gripped the market. Now let's understand the death spiral that destroyed Terra Luna. Step 1. When UST fell below $1, users burned UST to mint Luna for arbitrage profit as the mechanism was designed. Step 2. This caused massive Luna minting, which flooded the market with new tokens, causing Luna's price to crash rapidly. Step 3. As Luna crashed, more and more Luna tokens had to be minted to redeem each UST, accelerating the dilution. Step 4. Confidence completely collapsed. Both tokens entered a hyperinflationary spiral, with Luna supply exploding from hundreds of millions to trillions of tokens. Within days, both UST and Luna plummeted to near zero, wiping out billions in value. The impact of the Terra Luna collapse was absolutely devastating. $60 billion in market capitalization was wiped out in less than 1 week. Hundreds of thousands of investors lost their entire savings, left holding essentially worthless tokens. The entire ecosystem collapsed. All the decentralized finance protocols built on Terra became insolvent overnight. The collapse triggered contagion throughout the broader cryptocurrency market, causing a significant crash and widespread loss of confidence in stablecoins. Additionally, it led to increased regulatory scrutiny, with governments around the world implementing stricter oversight and regulatory pressure on cryptocurrency markets. This collapse revealed several critical risks inherent to algorithmic stablecoins. First, death spiral risk. Reflexive feedback loops can cause catastrophic collapse during periods of stress. Second, confidence dependence. The entire system relies on market belief in the mechanism. Once confidence is lost, the system fails. Third, no real backing. Unlike fiat-backed stablecoins, there are no tangible reserves to support the peg. Fourth, bank-run vulnerability. Mass redemptions can completely overwhelm the stabilization mechanism. Fifth, scalability issues. The mechanism breaks down under extreme volumes and volatility. And sixth, single point of failure. Heavy reliance on one use case or protocol creates dangerous systemic risk for the entire ecosystem. Let's conclude with the key lessons we must take away from this disaster. First, collateralization matters. Stablecoins backed by real assets like dollars, treasuries, or other tangible reserves are fundamentally more resilient than algorithmic designs. Second, sustainability over yield. Unrealistically high returns, like Anchor's 20%, are major red flags indicating unsustainable economic models. Third, stress testing is required. Systems must be proven to work under extreme market conditions, not just normal scenarios. And fourth, diversification is essential. Never concentrate your holdings in experimental or unproven financial mechanisms. The Terra Luna collapse serves as a stark reminder that in cryptocurrency, if something seems too good to be true, it probably is. Always understand the mechanisms behind your investments and never invest more than you can afford to lose.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.